guys, how you doing? Here we are again. We have this lecture, and then one more lecture, and then the test, correct? Over chapters 8, 9, and the first part of 10. And next period, we'll talk in detail as far as what's going to be on the test. Now, the title of today's lecture was Intro to Fixed Assets. We actually started at the very tail end of last lecture, starting to talk about fixed assets, didn't we? And we'll continue that today. So let's go ahead and take a look at the homework. I didn't give you much this time, did I? I think I just gave you 2 quick studies. I wanted you to do quick study 9.1, which was on credit cards, right? And this chapter, or this subject is covered in the accounts receivable chapter, even though credit cards really aren't pure receivables, are they? Okay. So let's go ahead and take a look at quick study 9.1. Prepare journal entries for the following credit card sales transactions. And the company uses the perpetual inventory system. Okay. Okay, in situation 1, we sold 10,000 of merchandise that cost $7,500 on MasterCard credit cards. The net cash receipts are immediately deposited in the seller's bank account. MasterCard charges a 5% fee, right? Okay. Now, if we would have, where'd I put my pen? If we would have, teacher can't find his pen. I got it. Crisis averted. Okay. If we would have just sold for cash, what would our journal entry have been? I know that's not what they asked you. But if we would have just sold for cash, our first journal entry to record the sale would be cash sales for how much? 10,000? But we didn't sell on cash, did we? We sold on credit cards. So our first journal entry is this right here. Okay? Our first journal entry is we don't get cash of $10,000. We only get cash of $9,500, which is 100% minus the 5% fee times the sales, right? The 5% that we don't get gets debited to credit card expense. So we receive less cash here, don't we, than if we would have sold it, not sold it on credit card. Correct? And they would have just given us the cash. So by allowing our customers to use credit cards, it does cost us something, right? But again, we talked about the benefits of credit cards last time. You don't have to evaluate the creditworthiness of your customers. You get your cash quicker. It opens up a whole new customer base that maybe wouldn't buy from you if you didn't offer the credit card option. Now, we do have to, however we account for this or however they pay for it, remember that you do have to also do your journal entry to debit cost of goods sold and decrease your merchandise inventory. Remember chapter 5, how there was 2 entries for a sale? So the situation number 1 requires 2 journal entries, and those are the journal entries. Okay? All right, any questions on that one? I know we have a second one here, but any questions on the first situation in Quick Study 9.1? Okay, let's do Quick Study 9.1, number 2. We sold $3,000 of merchandise that cost $1,500 on an assortment of credit cards. Now, here we don't get the cash right away. Net cash receipts are received 7 days later. Okay, so we submit those receipts to the credit card company and wait for them to pay us. So we have the entries we have to make. The first, for the first situation is this one right here. And we are not debiting cash. We are debiting 96% of 3,000, right? And we're debiting accounts receivable, not from the customer. Not from the customer, but from the credit card company. Okay? accounts receivable from the credit card company. Now we have to record our cost of goods sold as well. And then we have to wait 7 days, and then the credit card company pays us, right? And that's the journal entry 7 days later when we get our cash from the credit card company. We debit cash, and our receivable from the credit card company is decreased. Okay? All right. Any questions on that? Does that make sense, folks? Any confusion there? Credit cards usually are not too hard of a situation, but I always ask about that on the test. I want you to be familiar with that. All right, if there's no questions there, then let's jump over to the only other homework I asked, which was Quick Study 10.1. All right? Quick Study 10.1. All right. Quick Study 10.1 on page 421. Strike Bowling installs automatic scorekeeping equipment with an invoice cost of $180,000. The electrical work required for the installation costs $8,000. Additional costs are $3,000 for delivery and $12,600 for sales tax. During the installation, a component of the equipment is carelessly left on a lane and hit by the automatic lane cleaning machine. The cost of repairing the component is $22.50. What's the total recorded cost of the automatic scorekeeping equipment? Okay. Who got an answer? What'd you get? Very good. Nice job there. Sarah got it right. It is $203,600. We do not include the $22.50 repair charge because it is not a normal and reasonable expense that's necessary to get that asset in place. I mean, we would have to record the $22.50, but it would just go into like repair expense. It would not be part of the cost of the asset. Okay? Is that why you excluded it, Sarah? You're smart. Very smart. Okay? So that is the recorded cost. The other costs are reasonable and necessary in order to get that asset into working condition. Okay? All right. That's it for homework, isn't it? Probably just going to let you go early today. I'm kidding. You know that's not true. All right. Let's go ahead and talk about a subject that is a very important subject. And we'll do some work on it here in class. I'll give you some homework to do. And we'll go from there. What I want to talk about today is depreciation. Okay? Now, we have talked a little bit about depreciation in Chapter 3 when we went over adjusting journal entries. Is that correct? Remember depreciation? What is depreciation? I want to talk about what depreciation is, and I want to talk about what depreciation is not. Okay? What depreciation is the process of allocating the cost of plant asset to expense in the accounting periods benefiting from its use. Okay? All right, coming off the PowerPoint a little bit. Let's say that Jessica, that you purchased a $30,000 truck for your landscaping business. Okay? Now, it would not make sense to expense that entire $30,000 of truck in 1 year, would it? Okay? Because that truck's going to benefit you for a number of years. You with me? That doesn't really follow the matching principle. Remember the matching principle? We want to attempt to match the expenses to the periods in which they helped create revenue. So if we buy a truck and we just debited truck expense for $30,000, that doesn't really make any sense. Okay? Now let's say you think that truck is going to last 6 years in your business, and let's say you think that it's not going to be worth anything at the end of that 6 years. Well, you might decide to expense $5,000 per year for the next 6 years. You see what I'm saying? And that way, every year, you'd have $5,000 of depreciation expense spread out over the estimated time periods that you think that truck will be beneficial to helping you create revenue for your business. You understand? And we may make depreciation journal entries monthly, or we may do it annually. Remember how we talked about AJEs? Some people do them monthly, some people do them annually. So we just have to know. But in that sort of situation, it would make more sense to spread that expenditure as an expense over 6 years, right? And then it wouldn't mess with our income statement as much either, right? Think about if you expense that entire $30,000 in 1 year, you'd go, whoa, why didn't we make any money? Well, we had the truck purchase. Okay, it would really mess with your financial bottom line. Okay? So depreciation, going back to the slide, what we want to do is spread out that expense over a number of over the number of accounting periods that we think will benefit from it. In a way, we're going to take it slowly off the balance sheet and slowly expense it. Okay? Now let me tell you what depreciation is not. Depreciation is not an attempt to write down an asset to its market value. And this is very, very hard for people to understand or to really comprehend what we're talking about here. Coming off that, if I depreciate that $30,000 truck by $5,000 after 1 year, I am not saying I think the market value is $25,000 of that truck after 1 year. Okay? Because we do not record our assets on our balance sheets, generally speaking, trying to figure out the market value of them. Because what you think the market value of that truck is after 1 year versus what I think versus what Jake thinks versus what Allie thinks, that's probably 4 different amounts. That's too subjective. Okay? The layperson who hasn't had the privilege of taking Accounting 1, they think that balance sheets report, they just always seem to think that balance sheets report assets at their market value, what they're worth if we sold them on the open market. That's not the case. Depreciation is not an attempt to write an asset down to what we think is its market value. It's simply a spreading out of an expense. Are you trekking with me? Okay? All right. Okay, now we're going to talk about some different types, and each one of those types of depreciation, we're going to need to know the cost of the asset, the salvage value, which is also called the residual value, and this is what we think we can sell the asset for, if anything, at the end of its estimated life. Okay? In the example we just did, Jessica, we were just saying 0, which is probably the most common salvage value that people use in real life. But the salvage value and the residual value are the same thing. It's what we think we can sell it for at the end of its life. And then we have the third thing we need is the useful life. Now I want to point out something here that's important. Okay? There are 2 of these things that are estimates. Which are they?
The last 2.
Yeah, this one and this one. Now, we know the cost, we can just look off the invoice, right? But salvage value is an estimate that we make, as is useful life. Some people think financial accounting is just black and white. It's always 100% known numbers. It's not true. There's lots of estimates in accounting. And in depreciation, we have to estimate what we think the salvage value is, and we have to estimate what we think the useful life is. Okay? So these are some factors that we're going to need to know as we work on depreciation methods. Now we're going to learn in this class 3 depreciation methods. We're going to learn straight line, which you already know, or should remember from Chapter 3. We're going to learn something called units of production. And then we're going to learn a method called declining balance. And specifically, we're going to be learning the double declining balance. Okay, so that's what we're going to talk about today, is straight line, units of production, declining balance. Cool? All right. Let's talk about the straight line method first. The straight line, we calculate the depreciation expense for the period by taking the cost of the asset minus the salvage value or residual value divided by the useful life. Let's look at an example. On January 1 of 2012, equipment was purchased for $50,000 cash. The equipment had an estimated useful life of 5 years and an estimated residual value of $5,000. Well, how much would we depreciate? We would take the cost of the asset of $50,000 minus the salvage value of $5,000 and divide it by 5 years, and that means we will depreciate $9,000 per year. Okay? How does that journal entry look? Remember the depreciation journal entries? What does that spell? Do you remember that? D, E, A, D, dead. Remember that from chapter 3? Seems a long time ago, doesn't it? We debit depreciation expense and we credit accumulated depreciation for $9,000. Remind me what kind of account accumulated depreciation is? It's a contra asset with a credit balance, correct? So this is our entry, right? That's our entry. Now, one thing I want to point out. How would this look on the balance sheet after we had depreciated it for this first year? Well, on the balance sheet, we would have the cost of the asset of $50,000, okay, less the accumulated depreciation of $9,000, and that would equal $41,000. What do we call that $41,000? Do you remember? Does anybody remember what we call that $41,000? It's very important, and I want you to remember what that's called because we're going to be using it a lot in chapter 10. Does anybody remember what cost less accumulated depreciation is? That's the book value of the asset. The book value of the asset. Okay? So what does book value equal? Cost minus accumulated depreciation. What is the book value of an asset? Say it all together. Cost less accumulated depreciation. Cost minus accumulated depreciation is the book value of an asset. Okay? Because we're going to be working on problems where it says take the book value of the asset, and you're going to go, what is that? Well, that's cost minus accumulated depreciation. So that's how that would look after 1 year, correct? Okay, going back to this. So this is our amount of depreciation using the straight line method for the first year. This is our journal entry. We talked about what it would look like on the balance sheet. Now notice with straight line method, we take an equal amount of depreciation each year, don't we? Correct? And the book value, what does book value equal? Cost minus accumulated depreciation. The book value equals the cost of $50,000 minus whatever accumulated depreciation is. So $50,000 minus 9 equals 41. $50,000 minus 18 equals 32, and so on. So this is a little chart to help us keep track of our depreciation under the straight line method. And we depreciate down to the salvage value, and then we're done, aren't we? Okay? And of course, if we use a salvage value of 0, then that book value at the end of its depreciation amounts will be 0. But in this case, we used a residual value of 5,000. Cool? Now, sometimes they ask for what is the depreciation rate under straight line. Well, the depreciation rate under straight line is simply 100% divided by the estimated useful life. Okay? Whoops. The depreciation rate is simply 100% divided by the useful life of 5 years. We basically are depreciating 20% per year, aren't we? Make sense? Okay, cool. Any questions on that? Okay. One more thing they want to point out is, we take the equal amount of depreciation for each year, and the book value declines at a constant rate, doesn't it, for straight line? What's the book value? Cost minus accumulated depreciation. Now let's talk real quick about a different method that you haven't learned. And this one's going to be best learned actually by looking at an example. But bear with me as we go through this slide. This is called the units of production method. The units of production, the numerator that we start with is still cost minus salvage value. But then we divide it by what we think the total amount of production we think we'll get out of that asset is going to be. And this is going to be our depreciation per unit. Then each year we're going to take that depreciation per unit times the number of units produced in that period. Okay? The number of units produced in that period. You with me? So let's look at an example. On December 31, 2012, equipment was purchased for $50,000 cash. The equipment is expected to produce 100,000 units during its useful life. That's the total amount of production we're going to get out of that thing. Estimate, of course. And it has an estimated salvage value of $5,000. Now, in 2013, 22,000 units were produced. What's the amount of depreciation expense we take? Well, first let's figure out our depreciation per unit. We take the cost of 50,000 minus the estimated residual value of 5,000 divided by the 100,000 total amount of production we think we're going to get. And that gives us 45 cents per unit. You with me? Now, each year what we're going to do is take that 45 cents per unit times the number of production for that period. I think this example said that in 2013 we produced 22,000 units, didn't we? So 22,000 times that 45 cents per unit equals 9,900, and that's the amount of depreciation we're going to take in 2013. They don't give us an entry, but it would be $9,900 debit to depreciation expense, $9,900 credit to accumulated depreciation. Understand? Now, do you see under this method the amount of production for each year is going to change? So the amount of depreciation is going to change for each year. Here's that $9,900 for the first year, but look, the amount of depreciation expense for each year is going to be different because the units produced is different, right? And as a matter of fact, if for some reason the equipment is idle and it doesn't produce any units, this is 0, then the depreciation expense we take on that is 0 for that year. So each year we take that $22,000 unit times that depreciation per unit until it's fully depreciated down to its salvage value of 5,000. Are you with me? Now, can you think of any examples that it might make sense to use the unit of production method? One method, or one example where they might use it is, let's say that truck you buy will last a total of, we think it'll last a total of 150,000 miles. Well, could you see what we're going to figure out the depreciation per mile that we're going to take each period times the number of miles that we drove? You see what I'm saying? That might be a good way to spread that expense out. Again, we're not trying to mark it down to market value, but that might be a good way to allocate that expense. Understand? Now, I want to do a couple examples here in class of these two. So let's go ahead, while they roll that music, let's go ahead and do Quick Study 10.3 and Quick Study 10.4 in your book. You can see those right there. Okay. Quick Study 10.3 and Quick Study 10.4. Do these two, and we will come back in a few minutes and go over them. Okay, let's go over these. Quick Study 10.3, Quick Study 10.4. On Quick Study 10.3, on January 2, 2011, the Crossover Band acquires sound equipment for concert performances at a cost of $55,900. The band estimates it will use this equipment for 4 years, during which time it anticipates performing about 120 concerts. It estimates that after 4 years it can sell the equipment for $1,900. During year 2011, the band performs 40 concerts. Compute the year 2011 depreciation using the straight line method. Okay. Well, what we would figure out, first of all, is how much we're going to depreciate per year. And we would take the cost of $55,900 minus the residual value of $1,900 divided by 4 years equals $13,500 depreciation for the year, right? Correct? And of course, they didn't ask us to do the entry, but if we would, that would be depreciation expense debited and accumulated depreciation credited, in this case for $13,500. Right? Make sense? Okay. That's pretty easy, isn't it? Okay. What about 10.4, Quick Study 10.4? Well, here what we do, first of all, is we take the cost minus the residual value of $1,900, but here we divide it by 120 concerts, which we think is the total amount of production we're going to get out of that asset. And that means we're going to depreciate $450 depreciation per concert. Correct? Now, how many concerts did we do in this period? We did 40 in 2011. So we take 40 times 450, and that means we're going to take $18,000 depreciation in 2011. You with me? Once again, they didn't ask us to do the journal entry, but if they would have, we would debit depreciation expense and a credit accumulated depreciation for $18,000. It's not too hard, is it? Okay. Now, I promise you, I'm going to ask you to do this on the test. Okay? So let's move on to the third method. Now, the third method, I will tell you, is the method that students have a little bit more trouble with. Okay? And I'm going to promise you I'm going to ask this on the test, and I want you to be able to do it. Some students have just even left this problem blank. It's like, I don't even want to try it. Now, I really want to work on this. I really want you to understand this, okay? What it's called is the declining balance method. And what you're going to find with the declining balance method is that we are going to take, where's my pointer? We are going to take more depreciation or a higher amount of depreciation in the early years and less in the later years. And sometimes we do this because it offsets our repair expense, right? If you've ever had an automobile, you know that there's usually less repair expense in the early years of your automobile than in the late. So sometimes this balances things out on the income statement. But with the declining balance method, we're going to learn just the double declining balance method. And you're going to see that we're going to take more depreciation in the early years than in the later years. Okay? Now, how does this work? Well, you really want to walk through it step by step. Okay? You really want to walk through this step by step. The first thing that you're going to figure out is take the straight line. You're going to calculate the straight line rate. Now, do you remember when we did that at that one slide? You just take 100% divided by the useful life, and that gives you your straight line rate. So in this case, it's 100% divided by the asset we've been talking about has a 5-year useful life. So our straight line rate is 20%. Then we take that 20% and we multiply it by 2 because we are learning the double declining balance method. Okay? And that gives us our double declining balance rate. Okay? You with me so far? Then what we're going to do is we're going to take that double declining balance rate each period times the beginning period book value. Now what does book value equal? Cost less accumulated depreciation. Now the beginning period book value as we begin is $50,000 because that's the cost of $50,000 minus accumulated depreciation 0. We haven't depreciated anything yet, right? But how we did this is then we get $20,000 depreciation for 2013. Okay? You with me? Now, what is it for the next year? Well, for 2014, we're going to take the double declining balance rate times the beginning of the year book value, which in this case is the cost of $50,000 minus whatever we've depreciated. In this case, we've depreciated $20,000. 50 minus 20 is 30 times 40% equals $12,000. Are you with me? Now, students have a tendency to struggle with this. And so I have made up, and I don't know if this helps or not. If it doesn't, then don't use it. But I've made up this little worksheet to kind of walk people through this. Now, for you folks at home, I have this on Angel under the Chapter 10 lessons. Now, let's go ahead and take a look at that, and let's do the example that was on the screen using this worksheet. Do you remember what the cost was? It was $50,000. Okay? What was the estimated life? 5 years. And do you remember what the salvage value was? Wasn't it $5,000? Somebody double check it. Okay. So the estimated life, we have, that's EL, estimated life, cost is C. So the first thing we do is we take 100% divided by the estimated life of 5 years, and that gives us our straight line rate of 20%. We take that times 2, since it's the double declining balance method, and we get 40%. That is our double declining balance rate. You with me? So, depreciation expense for year 1, we take C, the cost of $50,000, times the double declining balance rate of 40%, and that gives us $20,000. That's the amount of depreciation for year 1. And we just did that on the screen, didn't we? What about year 2? Well, we take the cost of $50,000 minus, now this is the book value. This in the parentheses right here is the book value. The cost minus what have we depreciated so far? We've depreciated $20,000, and we take that times the double declining rate of 40%. And what does that equal? That equals $12,000. Okay? What about depreciation for year 3? Well, right here in between my fingers is going to be the book value of the asset, which is the cost of $50,000, minus whatever we have depreciated. Well, how much did we depreciate in year 1? $20,000. How much did we depreciate in year 2? $12,000. Okay? So the book value of the asset is actually $50,000 minus 20 minus 12. It's $18,000, isn't it? It's $18,000. And we're going to take that times the double declining balance rate, and that gives us, I believe, $7,200. Is that correct? Now, do you see how the amount of depreciation we're taking each year goes down? All right? Now, if that worksheet doesn't help you think through it, then by all means, don't use it. Now, you can pull off, if you fill this in, you can pull another one off Angel and use it again. But Dave Krug designed that. So every time that's used, I get 25 cents, which is nice. Okay? Got that going for me. Okay. So if you look at a depreciation table for double declining balance, there you can see there's our 20,000, which we calculated, our 12,000, which we calculated, our 7,200. And if we would keep going, these would be the amounts that we'd get. Now remember though, we only depreciate down to, well, let me back up. Here we have depreciated below our estimated salvage value. We can't do that. This ending number has to be what our salvage value is. So sometimes we have to force that last number because we want an ending book value when we're done depreciating equal to the estimated salvage value that we set up. If it was 0, it'd be 0, but in this case it was 5,000. But you're not just going to keep depreciating things until they have negative book values, right? So sometimes we have to force that depreciation expense in the last year. All right. Now, a review of these methods. The straight line method gave us equal amounts of depreciation for each year. The units of production method was different amounts in each year depending on what our production was, right? And the double declining balance method, it was it went down, didn't it? Less amount every year. Okay? Now I can guarantee you on the test you're going to have a problem, not a multiple choice, but a problem where I'm going to give you a bunch of information about a fixed asset and I'm going to want you to figure out what's the depreciation for the first year or so if we used straight line. Well, what if we used units of production? Well, what if we used double declining balance? And it's the problem on my test that people have a tendency to do the worst on. I want you to do well. Okay? I want you to do good on it. So let's do one of these in class. Let's do Quick Study 10.6. Quick Study 10.6. Okay? Okay, if you're not done at home, just pause and press play when you are ready. Quick Study 10.6. A fleet of refrigerated delivery trucks is acquired on January 5 of 2011 at a cost of $930,000 with an estimated useful life of 8 years and an estimated salvage value of $150,000. Compute the depreciation expense for the first 3 years using the double declining balance method. Okay? All right, I want to make sure we get through this. I might have to move a little quicker than I would have liked. But what was the cost of this truck? Or what was the cost of this equipment?
$930,000.
$930,000. The estimated life was what?
8 years.
8 years. And the salvage value is what?
$150,000.
$150,000. Okay. So the estimated life is 8 years. 100% divided by 8 equals 12.5%. We take that times 2 because it's the double declining balance method. And our double declining balance rate will be 25%. So I can just fill that in all of these, right? Okay, depreciation in year 1, the book value is just the cost. There's no depreciation yet. So the cost is $930,000 times 25%. That equals $232,500. Okay? $232,500. Did you get that? What about year 2? Well, you take the cost of $930,000 minus whatever we've depreciated, $232,500. Okay? And we take that times 25%. And that gives us, let me do that in my head real quick. If I calculate it in my head, I get 174,375. Is that correct? Okay. What about depreciation for year 3? I take 930,000 cost minus whatever we've depreciated. Year 1 was 232,500. Year 2 was 174,375. And you take that book value times 25%. And I'm going to go ahead and round this, but I think you get about 137,801. Is that correct? And the total accumulated depreciation now is 537,656. And it doesn't, we haven't depreciated below salvage value here. If we kept doing this, we'd get to the point where we had to force the final one. But we're still good to go. Now, I don't know, did that help? Did anybody use that worksheet? Okay, you can print those off on Angel if you'd like. Okay? Now, what I want you to do for homework is there are, for homework, I want you to do 5 exercises. I want you to do exercise 10.4 through 10.8. So do 10.5, 10.4, 10.5, 10.6, 10.7, 10.8 exercise. That's what I want you to do for your homework. Okay? Thanks, guys. Bye.